Good morning, everybody. Welcome to the Flow Show. It's the day after the carnage before. Morning, Kay. Morning, Stel.
Good morning. How are you?
All good, mate. How are you?
I'm good. I'm glad I don't bank with the American regional banks. Man, it's a poop show. Let's call it that.
How about you, Kate? How are you doing?
Yeah, I'm all good, mate. All good.
Yeah, you know what?
I'm trying to share a screen right now because we don't see anything.
No, I haven't done that yet.
Okay.
I'm going to be scared to hand it over to you, so when I hand it over to you later, I'm going to do it so I don't have to take it back in case I get this problem again. I'm not sure what's going on with that.
It's a good idea.
But anyway, so yeah, I'm having a morning where I want to be trading against these moves now. I think we're at that part of the show. I had a little look at the stocks, the banking stocks, and there's been quite a significant bounce in some of these small regionals. I don't know where the pre-markets are, but they're up again pre-market as well. There is a bit of talk that perhaps the meme crowd have got involved in these, and doing their old buy the dip stuff. But in real terms, it seems like maybe there's no further big fallouts to come. What do you guys make of it?
Well,
I would be very skeptical.
I wouldn't buy any regional bank stocks. I would just go buy the big ones because they are the beneficiaries of all of this. We've seen Citi, JP, BOA. They're speeding up their program to open accounts because they're overwhelmed by the demand to open accounts by all the companies who have had or having difficulties to get their funds out of the small regional banks. So yeah, I think if you wanna buy anything, buy the big banks. The rest is probably going to be too volatile. You might have like a quick gain on it because the worst may be over, perhaps. But yeah, I don't know. It's enough for the Fed next week to just raise 25 bps to put them back into trouble, I reckon. The smaller ones, the big ones, they will be laughing.
Yeah. Okay, well, let's go through.
Globally, I agree with you, and we're seeing that in risk pairs.
Yes,
and we've had exactly the same as we've had when was it a few Mondays ago, where we had the worst in Asia spilling over early Europe on the Monday morning, and then the whole thing reversed. So and we are seeing the same kind of moves this morning. If you look at yen pairs, for instance, Swiss is still stronger, but yen pairs, for instance, are back higher this morning.
Yeah, and I was actually looking at MEX, and I was hovering around here. I was watching this move, and I thought maybe if we don't get up to the highs, that's going to mark a top. Maybe that's worth having a little short in it. I didn't, and here we go. It's back below 19 and sailing lower. So I think, yeah, I'm getting twitchy. To fade some of these moves, and we'll talk about some of those as we go through the list of news headlines and the latest stuff going on. So we'll get straight into that. Over in Japan is a funny poll for you. NHK ran a poll of the Bank of Japan and what they're doing. 24% of those polled in Japan are for the BOJ to continue its easing. 11% are against, which begs the question: what do the rest of the 65% think about it? And the likelihood is that's all the old and aged, and they don't give a monkeys about it all. Very, very low numbers there for the Bank of Japan. 24% and 11%, leaving 65% not answering the question. That's a good bit of insight into the population in Japan, isn't it, Kay?
Yeah, I mean, it's not that they don't give a monkeys. They are so used to follow just what the government tells them, and most of those the elder generation, they have been used to bow, say yes, put your money in a savings account, and go drinking on a Monday night with the boss, and they're very tough to get them out of that pattern, because now they are actually forming the biggest part of the Japanese population. Probably just those 11% are probably the what is it, millenniums, or you call them, to say that they are that they are against it, and some people working at regional banks, and Japan is strange on that side. There's a lot of old traditions which are probably going to take another generation or two to get out of it, because those people are living long, right?
Yeah, exactly. And speaking of the regional banks, the Bank of Japan has noted that some regional banks have seen losses widen on their foreign bond holdings. Could it be that these guys also sitting in stale foreign bonds, particularly US Treasuries, while rates rise, and getting marked down on their books? Similar situation to what's happened with SVB, but obviously different dynamics with the regional banks. But losses are widening over there, at least in book terms. Some UK data out today, jobless data. Jobless claims fell 11,000 versus prior 12.9 thousand, so improvement there. Unemployment rate was unchanged at 3.7%. The employment change was up 65k. And on the wages front, wages, average weekly earnings were up 5.7% on expectations, but down from the 5.9% prior. If you take out the bonuses, they were down a touch well to 6.5% from 6.7%. Overall, still a moderately healthy looking jobs market over in the UK. Now, tomorrow we do have the spring budget from the UK. In the UK tomorrow, about midday, so I think that'll be coming out. A lot of the press already coming out with some of the bits and pieces that may happen, likely to happen. One of the things that Chancellor Hunt is looking to do is to raise a tax-free pension allowance, and this is apparently to discourage early retirement. So he's going to raise the amount that people can have in their pensions before they're taxed, which in his sense hopes to encourage people to stay and work longer to build up pensions to those levels. The downside of that is that if you're already at those levels, it means you can retire early anyway, because now you just get more tax-free. There are other tax changes that and benefit changes that he's looking at, potentially to help workers, low-paid workers with childcare, things like that. Overall, I'm not sure this budget is going to be too much moving for the pound. Obviously, any big tax cuts is what's going to move the quid higher, at least. But I'm not expecting any huge waves from this, but we'll keep an eye on what comes out tomorrow anyway. Not a lot of news elsewhere. It's all been about what's going on in the States. And talking of these small regional banks, one of the ones in the firing line was First Republic. They announced they've been able to meet withdrawal demands on Monday with the help of the additional funding. This is the stuff coming from the Fed and the Treasury. And that they're not seeing massive outflows of deposits. On SVB, the FDIC are potentially planning another auction of the business. They had a failed auction on Sunday trying to offload the bits and pieces of the bank. They're going to try that again. The Fed was out and Powell was out yesterday with some comments, which we might have been on watch for, as mentioned yesterday, even while they're in blackout for the FOMC. And while they're looking at what's happening in SVP, it's mainly a probe on its supervision of the bank. And they're going to run a review, which will be released May the 1st. Powell commented that the SVB failure demands a thorough and transparent and swift review. So again, it's more on potentially their failings as regulator to supervise and know that these problems were happening at the bank, or that there were potential issues at the bank, and thus all other banks. So this falls into the narrative that we've already heard from the Treasury, that they will be looking at regulations further to make sure this sort of stuff doesn't happen again. Now, what has this all led to so far? The biggest potentially market moving stuff that's happened is a big repricing of all rate expectations, literally across the board. Now, Timmy Leaks, our mate at the WSJ, said that SVB and the Signature Bank problems has called the Fed interest rate path into question, and it may get Fed members thinking a bit more cautiously about rates. Over the course of yesterday, traders no longer fully priced a 25 pip hike. Then Fed swaps priced 50 basis points of cuts by year end. Then they priced no more hikes for the rest of the year as a likely scenario. And on the CME Fed Watch, at some point, traders saw a 33% chance that the Fed holds rates at their upcoming meeting, and that market pricing shows rate cuts expected as early as June. Now, today, that particular pricing is a bit different. It's 74.5% for 25 pip hike, and the balance 25.5% for leaving rates unchanged.
Did you see Nomura's call?
I'm getting to that, mate.
Okay, sorry.
That was my very next line. Nomura is, and these lot have become a bit of a shock jock outfit in terms of their forecasts. These were the guys who I think it wasn't even a week ago, were predicting that Fed would need to take rates to 6%. Now they say the Fed are going to cut next week and halt QT as well. So completely flipping their calls there. It's spread among let me get the rate probs up as well while I'm talking about this. It's spread pretty much around to all central banks. Let's put that there for you guys, so you can see these rate expectations. So now traders apparently only pricing one further rate hike from the BOE. They only see a 50% chance of a half-point hike by the ECB. The Bank of Canada market's pricing in a cut at their next meeting. Even the RBA, starting to price a cut at their next meeting. So these rate changes have gone, I would say, pretty much too far to the extreme. Personally, I think that the Fed is going to go 25 next week, and I think, next week. I think the ECB are going to go there 50 on Thursday. I don't think there's going to be any change there. As I said yesterday, the only reason they would tinker with rates, not cut as much, that sort of thing, is if they are truly worried about financial stability from this issue. But unless further skeletons come out the closet, I don't see them changing policy personally. But something I noted in the chat room this morning, while we know the market likes to get fearful over things going pop, all these banks blowing up, and we've seen this market fear coming into play, central banks are also scared of not being able to do enough to stop this sort of thing happening. That can cause them to do funky things with monetary policy and other things. If they feel they need to show a strong hand that they are in control, provide liquidity to the market by easing financial conditions. So while I personally don't think it will happen, I'm not leaving it as a 0% chance that it will happen, and that they may tinker around with rates. Canada's regulator is also starting to monitoring Canadian banks for liquidity issues. The Bank of Japan said direct exposure of financial institutions to Silicon Valley is limited. The ECB and Eurozone BODs see limited exposure to Eurozone banks from SVB. We had ECB Stornoas telling a Greek newspaper he doesn't see any impact from the collapse of Silicon Valley on Eurozone banks. So this does look by and large contained to the US, but we still, as I say, don't know if there's any more skeletons waiting to pop out of any more closets. But I'm still of the opinion that maybe we've seen the worst of it for now. I wouldn't rule out the market still having a few wobbles, but it's going to take fresh news to get the market running up as scared as it was yesterday and Friday. So, boys, what do you make of it right now as we sit here now? Have we done with the fear? Is this just a pause? Do you see anything worse to come, or what's your thoughts?
Well, I personally wouldn't run ahead and say, yeah, it's all behind us. You know, the fear of contagion is always there. We've seen it before. And the question is, with these small regional banks, what have they done with their risk? You know, we saw Silicon Valley Bank basically not hedging their interest rate risk. What have the others done? You know, you have First Republic down, 60%. Yes, there's a reason for that always. So I am not sure we're done yet. But as Kay said, this is going to bring consolidation. So I don't think it's an event. I don't think it's even close to what 2008 was. So this is going to be an event where, some bondholders and some equity holders get zero. Deposits hopefully get guaranteed, and in a little while it's all blown over and we're past it. But I don't think it's done yet. So I still think there's going to be a little bit of nerves in the market, and I think that rallies will probably be sold. The other thing is CPI, which we have today. We have to not forget that there is a good chance, in my opinion, that CPI is going to be weaker than expected. There's a few people who have been talking about that, myself included, about how it's calculated. And I thought we would start to see that last month. We didn't. I really do think that it's going to start dropping on a year-on-year basis. And this is what the Fed looks at. So imagine if we're expecting 6% down from 6.4. What happens with the Fed if it prints 5.6, 5.7? What do they do? It's a tricky question. I don't think it's an easy question to answer, because I personally think that they're going to be very close to saying, right, we're done. Maybe another 25 hike and then we're done. Because, the combination of the uncertainty, the market uncertainty, and inflation coming down, I think this is what they are waiting to see with inflation. So, I wouldn't, I wouldn't brush this number aside. If it's on the weak side, I think it's going to have a big effect on the Fed. And I know they have the credibility, and it's going to be shot once more if they seem to be flip-flopping, back and forth. But you can almost feel how anxious they are to stop tightening and basically to see inflation come down. So I'll be looking at this number very carefully. I still think it's the most important number of the month. And on a weak number, I'm not talking about 5.9 or as tiny miss, but if we print something like 5.6, I think that's going to have a big effect on the Fed. Even though we're way above the target rate, the trend is lower.
So what happens on the other side if inflation comes in strong then? How do we match that off against what the market is doing at the moment with this SVB stuff and writing down Fed expectations? I mean, if you're right, if inflation is softer, then surely that runs in line with the market's current sentiment on rates, meaning that the Fed may pause and cuts may be coming sooner than expected. The pivoters are back in the game. But what if it's higher? What if it's unchanged, or as I say, even higher than last month? How does the market trade that? It's not going to suddenly switch back to pricing 6% rates, is it?
Well, the thing is, I don't think markets are pricing cuts now because of inflation going low, right? They're doing that because of the whole panic that's going on. So if we do get a high or a strong inflation print, that's a big question. I mean, I don't know if the Fed has to decide between saving markets and bringing confidence to the markets by not hiking, or by being more dovish than expected. If they have to decide between that or trying to tame inflation, I'm afraid they're going to choose the former, and they should be trying to control inflation. But any if there's any doubt about market stability, I think they're going to put a priority on that.
Yeah. Kay, what are your thoughts today and how the market reacts to CPI and the rest of it?
Yeah, well, first of all, we still have to. First of all, the Fed and the Treasury have responded to the liquidity problem, right? They've put this bank, what is it, BTFP or whatever? I never BTFP, right? I think bank term funding program in place. That should, for the time being at least, and that's how the market reacted now as well, put a temporary backstop to people who want to secure their repayments and money outflows. The rest, to me, is still a problem, a local problem of those banks not having been, and there's two reasons, and I've already said it yesterday. It's the bank's problem and the regulation problem. And if you look at the banks who are systemic important, they have very strict regulations as to how they manage their own balance sheet versus deposits and stuff like that. They always need to have this liquidity buffer, right? But it is not. It's the regulator. Well, they put that in place temporarily after the global financial crisis in 2008, and then they took away those rules, and those smaller banks they have just not done what they should have done when the Fed started to raise rates, and it's hard to do. I understand it's hard to do because you have this problem of hold to maturity and available for sale bonds, right? And they were like 90% in hold to maturity, and that means that if you sell only one bond out of there, you have to sell or revalue the whole book, which would have looked really, really bad if you are in hold to maturity bonds at 1.5%, 1.75%, and then all of a sudden you have to revalue them to 4%. And that was the fear, and that was caused the run. So to me, it's still a problem of those banks mishandling is not the right word, but just being perhaps ignorant and not manage their books responsibly. So it's not the problem of the big banks, and in that way, I think it's a temporary issue. It's a big issue if you look at it money wise. I mean, for anyone, billions and tens of billions or 100 billion, it's an absolutely big amount. But then you look at the treasury market or whatever, I don't know, I read some stuff on it, and it's like a $22-23 trillion market, right? So that's in that case, to me, in that respect, to me, it's still a storm in a glass of water, and there's people going to lose money on it for sure. Many shareholders and cross shareholding and whatever, they're going to lose money out of it. But then you see already that the big banks, they are speeding up opening of accounts for the same clients because they are overwhelmed with demand of people taking out their money of the small regional banks and putting them into JP Morgan, BOA, and the others, and Citi, you know. So in that respect, I don't think it's never been a credit issue, or it's not yet. Okay, if there is big contagion, I'm not going to discuss it. Can become a credit issue, but this is a liquidity issue. This is not a credit issue. This is not something where the banking system is in danger, right? So I reckon in that respect, it's going to be a storm in a glass of water. Now, on the Fed, before I talk about the CPI, I think the Fed, and again, you know, my point of view on credibility, credibility has been invented when the internet has been invented, right? Or when Twitter has been invented. For me personally, the Fed may have to react to something, but if they have to react to something, it will more be reacting to what's happening, and then we are here, and on CPI considerations. It's these SVB and regional bank problems will not show up in these numbers, that's for sure. On the other hand, there's if there are bigger liquidity issues than those facing right now, there is this thing that the US Treasury may need to sell T-bills to fund themselves, but they can't right now because of the debt ceiling. So there may be some other issues further down the line. So, but for the time being, I think no change. Okay, we erased the 50 BPs for the Fed, and now it's a question whether they are going to do 25 or 0. Base case to me still 25 as well, unless core CPI starts to really drop very close to 5% or so, and then the headline as Stelios was already saying, also closer to 5.5%, a faster drop. That may put them into the more holding pattern. What I do think though is that if it's not the end of the whole story, this liquidity issue, they may decide to tweak some of the QT they are doing right now, because that is tightening financial conditions quite rapidly, and it's been accelerating the tightening behind the scenes. We don't see that in the yields, but behind the scenes it's tightening. The reserves have already started to fall. Okay, there's still the reverse repo where the money funds are getting a lot of cash, which is still very high. But they could be tinkering some with the QT. Yeah, for the rest, I have actually no clue how CPI will look. I see half of the FinTwit sphere saying, oh yeah, and agreeing with Stelios, so yes, we are on a descending path. I tend to agree in a slow descending path, and then the other one saying that the February CPI is going to come hotter than expected. And then we have Biden, but did Biden really remember what he had been told 5 minutes before, or did he just make it up, or does he know the numbers? We don't know, right? So to me, I think the market has gone too far in all of this, but it's understandable because
has been coming.
What was that?
Have we lost him?
Yeah, I think we lost Ryan somewhere, because that was a very strange.
Hey, he's
comment.
there.
Yeah, I don't know if something refreshed on my computer.
Here we go.
Yeah. I was just saying that CPI has been coming down since the middle of last year. That's a trend. So even if it's come down from 9%. So even if we do hold up a bit here, it has done a lot already. And as we've seen in other countries, it may be getting to a point where, as much as it's gone up, it's come down some, and now it's going to stabilize a bit. So yeah, I think it's going to remain sticky for a while longer yet. Obviously, you've got to take into consideration Stel's thoughts that the accountancy tricks may be coming into play as well on that. But yeah, I mean, it's difficult. I think the Fed are going to stay their course. They've still got, if this banking thing is just a quick flash in the pan incident, and Gavin's right, what he says in the comments there, that it's going to perhaps take some time to work out what all the exposure is to these banks. But this could be a similar situation to what happened with the UK and the pension stuff last year. There was an issue, It was a contained issue. It wasn't contagious to everywhere else, despite the market thinking otherwise. It was dealt with pretty swiftly. And, you know, a few weeks later, it's all been forgotten about and everything's back going on as normal. So I think for trading wise, you've got to look at it in two ways. And one thing I've been looking at this morning is the 1 year yield, because at the moment it's trading below the Fed funds midpoint. So current Fed's funds rate is 450, 475. Okay, and the 1 year yield is trading below that. And I think that's where, if you're looking for mispricing or extreme pricing, this is the type of thing you need to be looking for, because even if the Fed go on pause, okay, they're going to be pausing at this level. So there's no real reason why, you know, a 1 year yield would be below that level. So if you're going to be looking for something to snap back, it's this sort of thing, getting back above that level. It's going to be a tough ask to get rates up to 5%. Again, even if the Fed indicate that they're going to be staying the course for rates and the dots go higher and that sort of thing, the market has been spooked by all this. Okay, and it's going to take a lot for those extreme rate increases to be borne out in actual physical markets like yields. But I could expect it getting up towards the 5% mark again, if all being well in things. And the same with the rest of the yields pushing back up. I think it's again a tough ask to see 10 years getting back to that 4% mark, or even now going above it. The market is going to be looking at, as we saw previously to this banking stuff, the short end going up much faster. But the insinuation is that the rates will have to won't stay up there for as long before they start coming down again. So looking at markets and you know, if, and this is a big if we have found a bottom, a top, whatever way you want to call it, in this particular instance, there's one way you look at trading it. And I'm going to use $MEX as the example. And it's things like this: seeing a high made at what may have been the peak fear point. Then today we're seeing an attempt up there, not getting quite as high. These are the sort of signals I look for to say, right, well, now whatever the noise is in here, whatever happened here, and you didn't want to be stepping in front of the train in these moves, but afterwards, what does the market want to do after? Well, we had a go at getting up there. It couldn't quite make it before it sold off. This sets you something to trade. This sets you a level. It says at the moment there is something up here going in towards 1920. The market doesn't want to push past. What's it going to take to push past that? Some more bad news that's got to be at least as bad as what we've had the last few days, or even worse. That's what it will take. If we don't get news that's as bad and we get attempts up here and it keeps holding, you've got a level developing. So if you want to counter some of these moves, look for the signals that can tell you that's what the price wants to do. The price, for all the news, doesn't want to go past this point. And you can take that for quite a few pairs. You know, dollar yens had a pretty strong bounce down into the low 132s, a pretty strong bounce. There's your marker. We know already 133 was a level. After we came down from 138, we went up, we had 133s, 132.90s as resistance before the break up to 138. We came back down. Yet we sliced through it initially, but soon after, we're here again, finding support in this area. So over these big news events, levels, and we said this yesterday, you don't trust the tech as much because it carved through the levels. But now things are a bit calmer. This is a time when levels may reassert themselves. So if we get back down to the 133 and we find it a support, that's your signal. The market doesn't want to push it as far as it did the day before. If it does push it there, can it get back down to this low? If it can't, again, it gives you a bit of a signal. If you want to jump in front of the trains, it gives you something to lean against, a line, a level, an area to lean against and say, right, I know where my risk is. I can trade into this level. If I'm wrong, I don't need to be wrong by 100 pips. I can be wrong by 20, 30 pips, because a fresh low says we're not done trading the fear, trading the issues. So everyone wants to look at markets and think, right, well, I want to get in. I want to get the rebound. if it happens? Well, you need to rely on the text and the price action to give you those insights to when to get in. But one thing I've been surprised about is that the impact in FX outside of EMs and maybe dollar yen, the impact's been pretty sedate, hasn't it, guys? I mean, look at euro dollar. You know, I would have thought, you know, dollar getting creamed elsewhere. You know, this would be trading up 118, 119 perhaps, yet we're still stuck in this, you know, we can't get 50 pips, 60 pips above 107 in all this. You know, is that what's keeping us contained in some of these close majors?
Well, it's not that we haven't moved. I mean, obviously the euro dollar has done a decent move, but the question is, why are the other pairs outperforming? Or basically, why is the dollar underperforming against the other pairs? And it's all about, well, actually, it's a good question. I
mean, look at that euro dollar.
What does Kay think?
From Friday, you've got 100. We've had 100.
Yeah.
Just look at differentials. Just look at differentials. When the dollar yields collapsed, the whole market went ballistic on the whole major interest rate sphere. Said it yesterday. Even the JGBs rallied, where the market expects Bank of Japan to tighten policy soon. It's just the differentials that is holding back big moves, because the European UK whatever yields they've all come down in tandem with the US yields. It's still only one trade, but as Stel was already saying, we had done moves. If you look at from the Wednesday close and then you have the Thursday Friday move, we've done 200 points in the euro dollar. We've done 300 in the cable, I think. It's still decent moves, right?
Yeah, but it's been within ranges. Look, you know, does any of this price move scream that there's
no? But the thing is, Ryan, we were going to the other side before it happened. We were going to the other side. The dollar was strengthening before it happened, right? And then it happened, and then we lost. If you look at the days before, the euro came off from 107 to low mid 105s. So now we are back above. Okay, it's not going that fast, but that's probably due to those yield differentials being less than we may expect if it's a pure US issue. That's
yeah, no, I get that. I guess the point I'm making is that if you know, you looking at some of the majors here, yeah, they've moved, but you know, you would expect in normal times currencies like the euro, currencies like the pound to move more over things when there's something like a banking crisis, but it's not. And what you lead from that again is the price action. You know, if this situation is resolved, you know, don't expect euro dollar to go to 102 on this or anything like that. So if you're looking for bang for your buck, if you like, on some form of resolution, if you're trying to pick what asset you to make the most on, if there is a solution to this, you've got to be careful what you pick, because you may not get big moves again in this. Yeah, it may go down back towards 106, down towards the 105s. Decent move for granted, but don't expect it to be explosive and go anywhere else. You know, I looked at the case of euro sterling. You know, we've probably had a bigger move this morning than we did yesterday while everything was kicking off, and that is largely down to that UK jobs data this morning, giving the pound a little bit of a lift, changing slightly rate expectations maybe for the BOE compared to what we're seeing elsewhere, but it's soon back above you know, the 88 handle, and it's back in the zone. But a bigger move there than we saw all through yesterday's carnage. So you've got to look around the page. You've got to look at the price action if you want to try and take advantage of some of these moves. Sorry, Stel, what was that?
I was just going to say, I think Kay's absolutely right. What's the main driver of FX pairs? Interest rate differentials, and we had US yields, European yields, Japan yields all dropping. You know, everything's going in the same direction. So yes, there is a crisis, It's not the 2008 like crisis. 2008, remember, the dollar just got bought against everything. Everybody just closed their eyes and bought the dollars. It's not that. So since we're not there, there is still some kind of logic in the market. And when interest rates are moving in parallel between the majors, then it kind of makes sense that the FX pairs also don't show, huge moves. I don't know. I mean, I'm just giving my 2 cents here.
No, your 2 cents is worth millions, mate. Let me tell you.
It's worth probably 2.5 cents.
Yeah, I guess I'm just trying to warn people against, looking for something where there may not be something, if you know what I mean. Looking for a strong reaction in pairs that you may not get that. There's other pairs you can potentially look at, other assets you can potentially look at. Brand, in a sense, chasing ghosts, in one sense. Mike, you're saying you're waiting for Lagarde next week to show you a better long entry for Euro. So expecting Lagarde to be a bit dovish next week, then, are you? You think they're maybe only going to go 25 instead of a 50?
It's this week, by the way.
Sorry?
It's this week, by the way.
Oh, this week. I'm getting. It's only Tuesday. I already feel like it's been a week. This Thursday, not next week. It's the Fed next week, obviously. So what are you waiting for from Lagarde, then, Mike? Let us know what you're looking for in that one. Right, so just looking around some of the other things. I'm not in a lot actually at the moment. Only Euro Sterling. My loan's continuing. I had a little plain oil yesterday. Where's that gone? There. We're knocking down around the old bidden levels, as we've coined them. I took a long yesterday down in this move here into this zone. A lot of people have got a bit of a wedge going on here from drawing lines off the top here and just these lows coming up. I'm playing it more of a range between 80 and 250 and these lows here. I don't like the way we bounce from here and we've come back down again so quickly. That suggests maybe we're going to have a little look lower. Obviously, the $70 mark is a big one for oil. If we break that, then that's potentially going to pour some petrol on the fire to see a move further down. But I'm still interested in playing the long side from this. The risk is well defined. I'm not sure I want to touch this zone right now, as I say, considering we've come back so fast. But I may have a little go at the $70 zone. Don't need to give it a lot of room. A couple of bucks on that maybe as a stop. See if it holds the range and we sit inside it. Some of the other things I'm looking at, again, that dollar mex, I'm keeping an eye on that one. I think maybe missed the boat on that one. But if we do get another move up towards that high, maybe even back into the 19s, 1910, something like that, I may look to play a short, just again leaving my risk against those prior highs. If it gets through there, something bad continues to happen from that one. Apart from the rest, euro dollar is just speaking about. Technically, I'm not looking to play anything up here. But, if we do see a move up to maybe the 108, something like that, we're getting into that next big zone up here. The 108.30's always been a biggie. Something to maybe look at to run into the Fed next week, perhaps. If the market is still going extreme dovish on the Fed, that may be something to look to counter on that one. Apart from that, I'm not looking at an awful lot. So if I hand it over to UK, I don't need to take it back after.
Oh, okay. I thought you were going to keep him. We just talk of your pictures in case you wanted to highlight something. But I'm okay.
I'll let you do dollar yen. Pretty much said it. I was only looking at dollar yen from the perspective if we see another move lower, if some of these levels hold down here, the lows 133s, that's the sort of area I'll be looking at perhaps to pick up some.
I mean, okay, I can take them over. So I'm running quickly over stuff that I'm looking at.
Yeah, go ahead, mate.
All right. Okay, and just talking about some stuff because people in the room know that I had been buying silver on the way down here. Yesterday I let some go. I thought there would have been already some resistance around 2110, so I let some go there. I let some go in the 2150s, and then I'm looking at this 2195, 2220 zone. Really, I think that's if we get through there after today's CPI, it's going to go higher. But if not, I'm going to look at do exactly the same again, starting to load them up somewhere around here if I can, and then on the way down again and perhaps into this support line as well if we see back below below 20 bucks. It's just to reload what I've sold out and then trying to get on there. Dollar yen, I think it's a bit interesting what's going on. Yeah, there is resistance at 34.40s. That's where we stopped it this morning. But the daily, that's where we stopped yesterday, 50, 55 DMA, depending what you look at. I'm usually looking at the 55. I think it's a bit random as well because of the event. But anyway, I mean, people were looking at that. Blake played it really nicely as well. And I bought it against this one yesterday, but I've let it all go far too early because we couldn't get a close above this 133.55, which is where the daily the Ichimoku top of the cloud lies. And I think that's going to be the interesting one to watch today after the CPI, because we will have had the event and then see where we close on dollar yen after CPI tonight. And I think 133.55 is going to be the barometer for strength or weakness on this one. And then we're starting to look if we can break above this 134, 35, 45, 134, 35, 45 or not. If we get back below 133.55, close below there should normally look relatively bad for a retest of the prior lows. I'm in the mood for saying that we overreacted a little bit on these smaller regional bank events, and personally, I'm looking to probably catch a knife again if it's going down there, unless CPI comes in, as we have said earlier, at really, really very low levels. Wiki on the cable. I was a tad surprised that cable didn't hold today after the labor report. We had this blip lower, and it lasted for half an hour on the euro sterling and higher on the cable. Lasted for half an hour, and then bang, rejecting the 122 again. Same here as for the yen. We have a clear zone, in my opinion, around 121.40. Above or below tonight will probably set the direction for a little bit. So that's what I'm going to watch. And then below 120.70 again, 120.5. That zone could come in as a support as well. If it doesn't, if the dollar really picks up, it's going to be a dollar play, right? If the dollar really picks up, why not have a look back below 120? But I think watch this 121.40 or so as a close of the day. Euro dollar, I'm really not spending too much time over it ahead of the ECB. We've held this 108, 106.80 line, went to test the 107.45. It's still in boxes, you know. I think if it goes back below 106.80, we're back in the other box, 106, 106.80, 107. But ahead of the ECB, I'm not really tempted in doing much in the euro dollar. What's happening in euro crosses is interesting though, and I think that is already an ECB play. Is that those euro crosses, you put in a low and then they rebound very easily. There's another one that I'm looking at, is euro Aussie. I was trying to buy this back in the 159 figure a quarter zone, never had it. But we already twice here we came down on a bit of better risk, the Aussie rebounding, etc. But we can't hold below 160 for the time being already. So I'm a little skeptical that I'm going to get any before the ECB here, because I think the market may be tempted to take the euro crosses for another ride ahead of the ECB meeting. What happens afterwards? I have no clue. I was pretty built up on the euro crosses into the ECB, but then I don't know how the ECB will really react. We could have a scenario of seeing a dovish hike, depending on what Lagarde wants to do. Anyway, we saw the euro yen, but look at the elasticity of the euro yen. We had this major sell-off in yen pairs, but we are already nearly back to this 144 zone, right? And I think that's really pre-ECB play and a bit of positivity on all the yen pairs this morning. Yields are creeping back up. The bit of a less stress in those regional banks, and in case one wonders how Kuroda thinks about all of it, they decided to buy ETFs overnight since the banking stocks got a bit of a hit in Japan. BOJ straight away stepped in to buy ETFs overnight. It's not a lot, but still they bought $600-700 million worth of it, perhaps $500 million worth of it, and that also helped to put the crosses higher. This one is a level to watch, in my opinion. 144.05, 144.0520. Keep an eye on what's happening around there. Yeah, I'm already on the dollar mix. We've highlighted this, and I've got the same zone up there, up to 19.25-ish. Unless it closes above this zone, 19.10, 19.25, I think the worst may be over for now. I'm taking a risk of saying that, but I think the worst may be over for now. Perhaps on the CPI this afternoon we've got a retest, and then I will see whether it holds or fails around 19.10 after the CPI, and see what happens. I may be a bit less tempted to do Euro-MEX right now ahead of the ECB. That's what I'm going to keep very close eye on post ECB on Thursday. Dollar rand holding. I think it's holding as long as we are above this 06-10 zone. It's holding, and you don't change the picture really. If we start to break below here and confirm it below 18, and then dollar rand can go deeper. If not, yeah, why not? A sticky CPI in the US could see this one take off again, in my opinion. So I'm still a buyer on dips. I did it yesterday, but took them off because I don't know what's going to happen on CPI. I'm really traveling extremely light into the CPI. Similar happened on this dollar China, and yeah, we had the drop on the dollar sell-off yesterday below this 684.85, 5.5 zone, but now we're already back above. The fact that Xi is really getting very involved in financial markets and affairs over there as well. We've seen some regulatory stuff coming out again, no later than this morning. I think he's going to keep the CNH from strengthening a lot. So give me a mild CPI number, not a falling out of bed CPI number. I may give it a try again here in the dollar CNH again if I can find low 680s. And I think that's enough for me, Ryan, right now. So you.
Thank you very much, mate.
Give it a go. Try.
Yeah, I'll give it a try.
It.
Let's see if we can. Let's see if it works. Let's see what I'm doing wrong this time.
I stopped sharing, so you should be free to have it.
Let's go.
Yeah, it's working.
Yeah, so it was you all along.
You see, I repaired it. You see.
You broke it, and now you're claiming a repair job.
Yeah, don't tell anyone you paid me 500 quid behind the scenes to repair it.
Yeah, it's working. It's working.
It's not blackmail. It's just IT services.
Yeah, exactly. It's an ID 10T error, and you can Google that one, folks. What that means. Yeah, interesting that dollar yen. Just going back to that, pulling up at that former resistance area that we were watching late Feb. You know, we all struggled up there for a time, and then it became support. That was from the bounce from the 127s. That was the top of the sort of range that we saw there, and then it carved through it on the way down. But here it is again, showing up. This is why I keep levels on my charts for so long, because you can do nothing with it, but at some point you've moved away, come back, all of a sudden it's a level again. You know, this is price action in its purest form, and that's what we love. That's where you get your clues from. Anyway, I've not got much to add to that, to what these gents. I don't know if Stell's got anything he wants to add into the mix before we shut up shop.
No, really, just want to note that Kate talked about silver. I'm still in my silver long. It's in the money now. I am going to be running it over the CPI. I think there's a good chance. You know, Biden talked about CPI on Friday and saying, "Well, I'm confident that it's going to keep going in the right direction." I don't think he would be saying this if he didn't have the number. But so I'm just going to keep it anyway. It's nicely green now, and I know Kay's been trading it really well, you know, in and out. That's what I usually do, but for this occasion, I'm gonna run it, see what happens.
Let it run. Let it run.
Every once in a while, you like the movie Ferris Bueller's Days Off. Every once in a while, you gotta say, what the, you know, what the heck?
Keep it clean. Keep it clean, mate. Keep it clean.
Yeah.
Cool. Well, thank you very much, gents. Astute input as always to the Flow Show, and thank you very much to all our people for turning up to watch it. Getting some great numbers through the door here. Thank you very much for all your support for that. Good luck over the CPI. Good luck with your trading. We shall see you all tomorrow for another fun day. Adios.
Take care. Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.